Welcome to Nasdaq TradeTalks, where we meet with the top thought leaders and strategists in emerging technologies, digital assets, regulatory landscape, and capital markets. I'm your host, Jill Malandrino, and joining me on the desk at the Nasdaq market site is Kyle Brown, CEO of Trinity Capital, and Ted Yarbrough. He's President and Chief Information Officer of Yieldstreet, and we're here to discuss the venture capital and alternative investment environments, what regions and sectors offer attractive opportunities, and the interest that we're seeing from investors of all types. It is great to have the both of you with us. Welcome to Market Site. Welcome to Trade Talks. Ted, let's kick it off with you. Give us some background on Yieldstreet, where you fit within this ecosystem.
Sure, Jill. Thanks for having us. We appreciate it. So I'm the President and Chief Investment Officer at Yieldstreet. We're a 9-year-old company, and we are very unique. We are a marketplace that provides affluent individual investors with access to private market assets, an asset class that we think most individual investors have been really underexposed to. It's really been an asset class for high net worth, ultra high net worth individuals, institutions. And our model is a digital model, direct to consumer, and just provides unparalleled access to a broad array of private market alternatives. And
Kyle, tell us about Nasdaq listed Trinity Capital having joined the exchange 2021.
You bet. Thanks, Jill. Trinity Capital is an alternative asset manager. We are focused on private credit, anywhere from late stage venture capital backed companies to private equity backed lower middle market. We are capitalized as an internally managed BDC, which is a really unique capitalization structure where we don't charge management fees or incentive fees, and a lot of the benefits that we see in our business flow to our investors. So.
There's been a big move in private capital over the past 18 to 24 months. We're starting to hear about it more and more, investor interest as well. Why do you think that trajectory continues to move higher?
You're seeing more and more interest from high net worth family office, and then from retail investors who want access to a growing sector. A lot of this lending was done by banks over the last decade. With some of the banking volatility, there's really been a gap created. And so if you want access to these loans to private companies, you need to find an alternative asset manager. You have a lot of institutional dollars that's been flowing to a handful of large asset managers. And most of those groups are chasing middle market to upper middle market, some of the same deals. And investors are looking for more alpha-like returns, and they're looking to more emerging-like managers in the space. And so I think you're continuing to see the market grow. Banks are lending less, alternative managers are lending more, and investors are wondering, who are these companies and how do we get access to them?
Yeah, and Ted, to your point earlier, traditionally it's always been the ultra high net worth individual, and the amount of disclosures and determining how appropriate were investors were to these types of investments. It sounds as if that has changed, and it certainly has been more democratized than it has been in the past. How are you ensuring at Yieldstreet that investors are understanding the types of products that they're getting into?
Yeah, but to your point, I think we're seeing a lot of the discussion within the alts industry is how do we get retail more involved, because everyone is noticing or realizing that that's an untapped market and very much been underserved. We spend a tremendous amount of time on education, on making sure that we explain how these deals work, make sure investors understand how these fit within their portfolios. One of the things that we noticed is most of the financial literature that's written, it's written by financial professionals for financial professionals. And when you present it to a lot of individual investors, it's confusing, it's opaque. And so we've actually spent a lot of time understanding that voice, that way to really kind of convey what the benefits and risks are of the different investments that we offer on our platform. So it's something we spend a tremendous amount of focus on.
Yeah, and you had mentioned, Kyle, that there's alternative forms of lending that is becoming more popular. Do you expect that trend to continue? And what areas or sectors or regions are you looking to put capital to work?
Sure, so I do think it's going to continue. Our pipeline says it's going to continue right now. Banks are still, I think there's regulation that they're still thinking is coming down. Maximum check sizes has come down, and so that continues to open up the door for alternative lenders. We're really interested in infrastructure, in manufacturing. I think there's been a trend for a while now for manufacturing to come back to the U.S., especially for private, smaller companies. And we're there to service and to finance some of the CapEx needs necessary. I think the AI boom that you're seeing right now, most people don't realize how much infrastructure needs are necessary for this to become a realization. Anywhere from just data center build outs, real estate, to GPUs, to power infrastructure, That costs a lot of money. And
It is
so
capital intensive, those projects,
it
that's
is capital
for sure.
intensive. And so you have a lot of lenders that are looking at that. And a lot of these companies, these cloud computing companies and AI operating companies, they're not profitable, and they're figuring it out. And traditional bank financing is just not going to be the best solution for that, which leads to alternative financing. And because there really is assets there, there's something to capitalize.
Right, and that's where, Ted, you're seeing investors on Yieldstreet, they're looking for other types of investments relative to traditional portfolios. So it's almost like the more product that's being developed on the venture cap side lends to more product that's available on Yieldstreet.
Yeah, absolutely. And I think in response to the presidential election with the Trump administration coming in, again, I agree with Kyle. I think there's going to be a tremendous investment need in digital infrastructure that's going to support AI, that's going to support crypto, which has obviously been on a tear. Banks can't do that. A lot of these types of financings are going to be longer duration, which really are not very attractive for banks given their capital position. And I also think for a lot of traditional institutional investors, those are also difficult deals to get their arms around because they're not profitable. There's a lot of things that are speculative. So there's great opportunities, I think, within the alt space, whether it's funds, like yours that kind of look at these situations, or the platforms that we have where investors say, well, I have a view that AI is going to be something that's going to change our economy. I don't know how to invest in it.
Right.
What can I do? I think that crypto is something that I'm very interested in. How do I get access to that? And again, whether it's energy infrastructure, all those assets classes, all those industries are undercapitalized right now, or they don't have tremendous access to capital. There's tremendous capital in the hands of these high net worth retail investors. And what we're trying to do is create the avenues that allow that capital to find the appropriate investments for them.
Yeah, I would imagine there'll be a lot of private-public partnerships out of this as well, if we're expecting, more infrastructure spend and perhaps the regulations to get more friendly to execute on these projects.
Yeah, I think it's going to be necessary. I think you're going to have to see public sectors really look and say, hey, if we're going to actually see AI come to fruition, we're going to need to have a different way for these companies to access power. I think some of the most interesting parts of maybe the AI boom is that for it to be successful, we're going to need new developments on technology, GPUs, power infrastructure, and you're going to see some outcomes here that I think most people are not even thinking about. There's new innovation happening all the time, which is leading to new investments from VC, PE, and otherwise. So it's leading to a boom of many peripheral businesses.
I'm sorry, go ahead.
No.
Oh, they're going to follow up on that. You had mentioned, Kyle, before, late stage. Is there a reason why you're more attracted to late stage investments relative to other parts of the cycle?
Yeah, so we focus on really kind of pre-IPO, pre-M&A, companies that have already developed technology. They have already found a product market fit, and our money's going into marketing and sales. We de-risk lending to growth stage venture-backed companies by making sure they have real technology, they have underlying contracts, and they have real value there in their IP or their assets. And so as a lender, you don't want to take risk where you're constantly looking at, am I going to lose money? And so we focus on that space, and then we also do that to make sure we have a one-stop shop for growth-oriented businesses. At a VC-backed company, they're going to be growing at a 50+% annual growth rate, and then we can stay with them through their life cycle as they come in with a PE group who might do that M&A, and then kind of carry forward as they head into that 3 to 50 million of EBITDA stage with the company. Right. So for us, it's just creating a full cycle, one-stop shop for growth-oriented businesses.
Yeah, and Ted, are there specific areas of alternative investment? You had mentioned digital assets before, which of course, if we were to see that regulatory framework and the administration really be behind it as they have campaigned on, I mean, that could certainly experience a run, and we saw that with the immediate reaction following the election. Are there other areas in alternative investments that high net worth individuals are interested in? And another thing is too, with the growth of family offices, they're pretty sophisticated and they want, let's call it, not the NVIDIA in the public market, they want to find it before it gets there.
Yeah, I agree. I think what's been interesting is the interest from our retail investors has very much mirrored what we see on the institutional side. If you think about the last 2 years or so, you're very smart to go into debt products or real asset type products where you get really high yields given where interest rates had been. And people made a lot of money in that. What we're seeing is our investors start to move and be interested in more traditional kind of equity type risk, I mean private equity or venture capital, into sort of other different types of alternative assets and not just be focused sort of on the shorter end. So if I look at what's in our pipeline, what's available on our platform right now, it runs the gamut from short-term debt to much longer term, either single asset equity risk or fund risk that's focused on PE, GP stakes, venture, et cetera. Bring up another good point. Family offices is a massively growing part of this sector. You would think that they would be getting great coverage with opportunities, and they're really not. So we've actually found a niche within our business with these family offices, the ultra high net worth, but they're just sort of a little bit below that institutional level, and so they're not getting the same type of deal flow. So I think that's a great area and a great market that we think we'll continue to be able to go after.
Yeah. Kyle, what is the impact if there is a shift in the economy, regardless of what administration is in? Should we get a downturn, or if the economy continues to fire on all cylinders, how does that impact the private space?
So the dam has been leaking for a little while on M&A activity, right? You have a record amount of dry powder on venture capital sitting on the sidelines, a record amount of dry powder on the private equity side, and it's been looking for a reason to break the dam.
Right.
And there's a couple restraints. One is valuations. 21 and 22 with the ZIRP policies, you had companies receiving valuations at an increasing amount to a point where it just didn't make sense anymore. And so you have companies that are holding off, trying to move into that valuation that they got in 21 and 22, and that restraint has made M&A activity really spiral downwards. And so you've had this bleeding of valuation happen over the last couple of years, and it's really starting to get to a point where companies have to, they've got to face the music. And the money's there for the deals to happen, and it's been waiting for some excuse. So whether that's some of the policies maybe that are coming, or less regulations, or just a new administration, is that enough to break the dam? I don't know, but I will tell you we're seeing increased activity, especially with our sponsor finance business, our PE buyout for kind of sub $1 billion companies. It's up 20% quarter over quarter, 15% year over year on M&A activity for tack-on acquisitions. That's showing me something. The dam is starting to leak a little bit more right now.
Jill, I agree with that. There's a real pent-up demand, or a pent-up supply of exits, if you will, and a lot of people have been holding on, and it's backed up a lot of parts of the finance system. So I think you're going to see a big increase in M&A, particularly in some of these industries that are going to benefit the most, I think, from a lower tax, lower regulatory environment that we expect with this White House. And that's going to open up things everywhere. So I think it's going to create debt opportunities, create equity opportunities, venture opportunities. And I think you'll see a real shift in this market to be more transaction heavy, and a much more risk on attitude.
It makes you wonder if this valuation reset was necessary in terms of, let's not think about through the lens of growth at all costs, and really focusing on the operating and core business, right? Perhaps that did need to happen, because to your point earlier, there was just so much froth. Now you might, you should have companies that are operating more efficiently and executing well to deserve those multiples that they were getting.
Yeah, so I think you had a situation where, we had this time period where rates were really low, coming out of the crisis. So risk was basically free. So you saw a lot of inflation valuations. We come out of COVID, inflation hits, the Fed comes back very aggressively with rate hikes to slow things down. You start to see valuations go down for companies that are otherwise very solid. They just had the wrong capital structure for that interest rate environment. And so to me, what we've been seeing over the last year or so is really a repricing of the market and a repricing of the assets. So it's not a distressed company, it's a distressed capital structure. So I think, again, you made the right point. You needed that one inflection point that's going to break that dam open a little bit. And I think that's what we've been seeing first with the Fed's inclination to start lowering rates. Even though that's stalled a little bit, inflation's still a bit sticky. But again, I think with sort of the political environment being more pro-business and more commercial, I think that may push people to be more transactional, and we'll see things open up a little bit.
Yeah. I think with VC-backed companies, the pain happened a couple years ago. Like, the message was received very clearly a couple years ago: tighten things up. You're not going to get money at a higher valuation. You may not get any more money, and if it does, it's going to be very painful. And so you've seen VC-backed companies over the course of the last 2.5 years really tighten up, run more efficient business models, really focus on that bottom line. And we've seen that within our own portfolio. I think you've also seen in that sector, valuations have corrected just subtly and really not in public sight. And that comes in the form of convertible notes. So the money's been flowing. If you take out 21 and 22, VC equity funding is back on pace with record levels of funding back in 2020. And so what does that mean? That means that companies are receiving the capital, but they're coming in securities and in forms that really are not priced rounds, but they're kicking the valuation can down the road, right? And that's been happening for 2 years. And a lot of these companies are now looking for an exit. VCs need an exit, or the private equity firms need an exit. And it's time to face the music.
We've been seeing the same thing with existing investors continue to invest into the asset or the company, and now we're starting to see more third-party money come in, again, which sort of validates or forces that reevaluation of the valuation of that company or the asset, and again should create more flow.
But that should make you more comfortable as an investor that you are putting money to work in companies that are worthy of an investment. And again, from an operational perspective, you should, it kind of makes more sense.
Yeah, our average loan to value is somewhere between 15 and 20%. And we're seeing valuations come down, which creates a really great entry point for a lender, especially when you have warrants, because now you're getting warrants at a lower valuation that can provide more upside in the future. So it's a really interesting time to be investing in companies, and especially with companies that are doing well and growing in this environment. That just shows you the health of that business.
What does that mean in terms of growth for Trinity Capital as a publicly traded company? What does that mean for your model? How does that impact your outlook?
Sure. We've seen continued increase in pipeline activity since 2022 and some of the banking volatility that happened. The private credit market is growing. Companies continue to stay private longer. And we're seeing more and more opportunities to take over really in that kind of late stage VC to 50 million of EBITDA. A lot of money is flowing to large credit firms who are all focused on the very same 500 million to $1 billion check sizes for upper middle market companies, and it's left the lower middle market PE-backed sponsors wide open for us. And so we love it. We think it's great. We write checks $20 to $100 million, and there's just not a lot of groups focused on that space right now because they have too much money.
All right, so good outlook for Trinity Capital as well. And then Ted, to wrap up here, Yieldstreet, give us some outlook there.
I think that we're following the trends that we talked about during this discussion. I think this is the first time I've seen over the last couple of years where we're seeing real investable opportunities across the entire capital stack and across all the various asset classes, whether it's real estate, whether it's private credit, securitized credit. We even do esoteric, assets like art or litigation finance. And again, an increasing interest in taking more longer term risk, whether it be in equities or venture capital. Obviously we have to be very prescriptive and as we evaluate deals and which ones we think are going to be suitable for our investors. But we're really risk on, and I think we'll still see a lot of interest in private credit. I think there's still more room to run and really great investments where you can get great yields. But I think looking at more risk assets, more equity type investments, we'll see that continue over the course of 25.
All right, appreciate both of your insights. Thanks for joining us on Trade Talks, and thanks for joining me from MarketSite. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.